Dear viewers, my name is Dr. Sharat Khandaka, and today we are going to discuss about the bond markets and interest rate risk. Now, before going to the lecture, I would like to discuss about a few important issues. First, the time value of money. Now, when we'll be looking for the bond price calculation or the bond market, we need to understand the time value of money. People would prefer to consume today rather than later. However, a dollar today is worth more than a dollar in the future. So if you have a dollar today, you can invest it and earn interest. The future, the dollar is received in the future, the less is worth because people prefer to consume today. So if you have $1 today, and if someone promised you to give $1 after 1 year, which one you're going to prefer? Of course today, because dollar worth today higher than the dollar worth in the future. So how we are going to calculate the future value of a dollar? So the future value represents FV in here, equivalent to PV, which is the present value of the dollar, 1 plus the interest rate, power n. In this slide, n is the number of year compounding. So for example, if the money compound twice in a year, so n would be 2. So if the money investing in for 4 years time, so in that time, if it's compounding twice in a year, for the 4 years, it will be 4 multiplied 2, which is 8. Now, another interesting issue we need to understand for the bond price calculation is the present value. Now, the present value, as we know, is equivalent to future value 1 divided by 1 plus I power n. So, PV is the present value, FV is the future value, 1 divided by 1 plus I is the interest rate in the market, and power n is the number of time it will be compounding. So the functions of the capital market and the long-term debt security. Money market securities are used to finance short-term projects, as we know, because money market instruments are for up to 1 year. However, for the capital market, the instruments could be for a longer time. So funds like to match the expected life of an asset with the maturity of the debt. So fund will be looking for the matching principle, which suggests that the long-term asset should be funded with the long-term liability. The capital market allow firms and the government to issue long-term security, and with the long-term debt, the cost of fund may be known for a life of the asset, and there are likely to be fewer refinancing problems, because in the money market there could be refinancing problem for the future. Now, who are the participants in the capital market? Capital market brings together borrowers and supplier for the long-term fund. So we're talking about here for the long-term instrument in the capital market, which could include shares, debentures, long-term notes, and so on. The largest purchaser of the capital market securities are the individuals and household, and the largest issuer are the Commonwealth and the state government in Australia. So when we're talking about the capital market instruments, the first thing come our mind is the Commonwealth government security. Commonwealth government securities are the Treasury bonds, notes backed by the credit of the Commonwealth government. Treasury bonds are the coupon instrument, whereas the Treasury note are the discount security. So if you look at the Treasury bond, these are issued for the long time, so it also includes some coupon payment for the investors. And coupons are generally paid twice in a year. On the other hand, the Treasury notes are the discount security, and it does not pay any coupon payment during the time. This is to note that before the global financial crisis, government surplus had reduced the need of the government to issue the bonds. However, in 2014, the value of the Treasury bond issued was about $233 billion. T-bond, or the Treasury bond. Treasury bonds are considered default risk-free. New issues are sold by tender and have 5 and 13 years to maturity. The issuance process is conducted by the RBA. Bids are expressed in terms of yield to maturity to 13 decimal places. And this is to note that the bid with the lowest yield is accepted first for the Treasury bond. The Reserve Bank of Australia also issue Treasury indexed bond. The issuance of the Treasury index bond was suspended due to the low investor demand in 2013. However, because the government was borrowing more money during the global financial crisis, the suspension was lifted. Treasury index bonds are the medium to long-term securities issued by the Australian government, for which the face value is adjusted for the movement of the consumer price index, or we can also call CPI. Coupon interest payments are made every 3 months instead of every 6 months at the fixed coupon rate, and adjusted capital value referred to the nominal value of the bond. On the maturity date, the last coupon interest payment and the nominal value of the bond, which is the par value, the value as adjusted for the movement of the CPI over the life of the bond, is paid to the bondholder. So remember, at maturity, the bondholder will receive the face value of the bond, which is adjusted for the CPI, as well as they will also receive the coupon payment. Another interesting types of bond are called semis. The semis are the bond for the state government. These are issued by the state financial authorities and are backed by the credit of the particular state government. However, this is to note that unlike CGS, semis are not issued through the tender system but issued to the dealer panel. This is also to note that as the Commonwealth Government bond or the T-bond are risk-free, however, semis are not risk-free. A large portion of the semis currently on issued are offshore. For example, the half of the semis are issued by the Queensland government in Australia. As we understand the definition of semis and the Commonwealth Government securities, so what are the difference between them? So look to these points. Semis are traded at higher yield than the Commonwealth Government securities, and this is due to the following factors. Number one, state government debt is not considered risk-free, and second, semis are not as liquid as Commonwealth Government security and therefore attract a liquidity premium. Corporate bond. Corporate bonds are debt contract are requiring payments of interest periodically and the repayment of principal at maturity. Corporate bond can be unsecured notes or the debentures. Corporate bonds are usually issued in the denomination of $1,000 and pay coupon interest semi-annually. So what are the difference between the unsecured note and debentures? Unsecured notes have no specified collateral attached to the bond. However, the debentures are secured by specific assets of the corporation. Now, this specific asset could be the land, building, equipment that can be placed as a collateral for the debenture. Sometimes the corporate bond might have a sinking fund provisions. This provision requires the corporate to place fund with a trustee to retire a portion of the debt issue each year. The trustee may retire the bond by purchasing them on the market or calling for them if a call provision is also present in the bond contract. Now, this is quite a popular provision for those types of company which do not have high credit rating. The next slide is about the hybrid security. Hybrid securities have characteristics of both debt and equity. By the name, we can understand that it has the characteristics of both the debt instrument and equity instruments. And hybrid securities have a set coupon rate and are convertible into equity as a set conversion date. The market for the hybrid securities have been growing very rapidly in recent years. The common features of hybrid securities are having a reset date. Now, two examples could be for the hybrid security. One is the preference share and second is the convertible note. If you look both this instrument, convertible note and the preference share, it is an equity instrument from the very beginning. On the other hand, convertible note, it's a debt instrument, but both this instrument can be converted to an ordinary equity at a predetermined date. So let's look at the features of the convertible note. Convertible notes are hybrids that can be converted into equity at the holder's discretion. These convertibility features permit the holder to share the good fortune of the firm if the stock price rises above a certain level. It is the investor advantage to convert when the market value of the stock exceeded the market value of the note. The primary market for the corporate bond. The new corporate bond issues are brought to the market through public sale or the private placement. Public sales are made through an investment banking firm that purchases the bond from the issuer and resell them to investors. On the other hand, the private placement is placing the bonds to an institutional investors or a large investors on private basis. However, the private placement are not very common in Australia and are mainly used to issue bond into the United States. The secondary market for corporate bonds. Some corporate bonds are traded on the ASX, but most trading occurs through the dealers. Corporate bonds are less liquid than the money market securities. The low liquidity stems from the more complicated features that makes the valuations difficult and the longer terms to maturity. In the capital market, there are also different types of other bonds. For example, the credit trapping bond. The credit trapping bonds are issued by companies with a lower credit rating. These are usually companies with a predictable earning but high gearing. The credit trapping lowers the yield on these bonds and can represent interest saving for the issuer. A good example for the credit trapping bond could be the IT companies. As we know, the IT companies, they spend a lot of money for the research and development, and they do have a very sustainable earning or predictable earning. However, they might not have a very good credit reputation. So in those cases, they can issue the credit wrapping bond. There are some other bonds as well, such as the offshore bond. Many companies and the government obtain financing in countries other than their own countries, or we call the home countries. For example, National Australian Bank, NAB, Commonwealth Bank. All these large Australian banks, they issue offshore bond in the USA and the European market. One of the main factors for issuing offshore bond includes the interest rate factor. Offshore bond issuance among Australian corporation entities increased from $60 billion to more than $460 billion between 1994 to 2009. And most bonds are issued in the major currencies like the US dollar, euro, and yen. This chart shows the growth of offshore bond issued by Australian company. If you look at it here in 1994, where the size was quite low, around $60 billion, it increased dramatically. And the main reason for this dramatic increase of the growth of the offshore bond is the interest rate factor. So if you look at the Australian interest rate compared to the other counterparts, for example the USA and the Europe, you will find that Australian interest rate during 2000 till 2017 or 18 was much higher than the other countries, and this helps the growth of the offshore bond issued by Australian large corporations in the foreign markets. Regulation of Australian financial market is three-tiered, which includes ASIC, which is responsible for the market integrity and consumer protection. APRA is responsible for prudential supervision of deposit-taking institutions. And third is the RBA, which is responsible for the stability of the financial system and the payment system. Now from the next slide, we look for the bonds market pricing and how we can calculate the price of the corporate or the government bond. This is to note that the price of a bond is the present value of the bond's cash flow. So when we're thinking about the bond cash flow, it includes the present value of all future coupon entitlements plus the present value of the face value. So before we can apply the present value formula to the bond's cash flow, we need to understand the nature of these cash flows, because it has two types of payment as we already discussed. One is the coupon payment and the principal payment, which is basically the face value. So the coupon rate. The size of the coupon or the interest payment is determined by the coupon rate. For example, if the coupon rate is 7% per annum, a bond with a face value of $1,000 will pay $70 per year in interest each year. Now, we'll call that the coupon rate. However, this is to note that bonds generally provide semi-annual coupon payment. So each coupon payment will be, in this case, 70 divided by 2, which is 35. The next things we need to understand is called the term to maturity. The bond's term to maturity is the number of years over which the bond contract extended. In Australia, where the semi-annual compounding is normally assumed, a 7% bond with the face value of $1,000 and the term to maturity of 10 years will make 20 coupon payment of $35 each. So let's look at this example again. That the bond is paying 7% coupon payment and the face value of the bond is $1,000 and the bond issued for 10 years. So it will make 20 coupon payment because 10 years multiply 2, which is semi-annual coupon payment, which is 20 coupon payment of $35 each. This slide shows the bond pricing formula. Now look this formula very carefully. This is a very important formula for you. Now the formula has two different parts. The first part is the present value of the coupon payment, and the second part is the present value of the future value. So in this case, P is the price of a bond, C is the coupon payment, 1 minus 1 plus I is the interest rate, power negative n, because we are calculating backwards, n is the number of time it will be compounding, or we can say the number of years multiply the number of time it will pay coupon a year divided by the interest rate. So this part will calculate the present value of the coupon stream, and the second part is A multiply 1 plus the interest rate power negative n. So A is the face value of the bond. So in our calculation, for example, it would be $1,000. 1 plus the interest rate power negative n. N is the number of term compounding multiply the number of years the bond has been issued for. Now let's look at an example. This example is for the fixed interest security or a bond. Current AA plus corporate bond yield in the market are 8% per annum. What is the price of an existing AA plus corporate bond with a face value of $100,000, paying 10% per annum half-yearly coupons and exactly 6 years to maturity? So from this example, we can understand that the face value is $100,000. Coupon payment is 100,000 multiplied 0.10 divided by 2, which is $5,000. Now 10% is the coupon payment, which is divided half yearly, so divided by 2. Interest rate is market rate, which is 8%, divided by 2, which is 4%. We're taking in decimal places. And N is 12 because the bond is maturing in 6 years time and it's paying half yearly coupon, so it's 12. So if we put everything in the formula, it will look like this. So if you put everything in this formula, you can find that the present value of the coupons will be 46,925.37 cents, and the present value of the face value will be 62,459.70. If you add both this value, you will find the present value of the bond would be $109,385.07. Hopefully you understand this calculation. Please look into some other video to understand more calculations from the bond market. There are other calculations from the bond market which are uploaded separately on my YouTube channels. The another types of bond that you must be familiar with is called the zero coupon bond. Zero coupon bond do not pay coupons to their holders. The bond sell at discount to their face value. So the calculation of the zero coupon bond is very similar like a discount rate security. Because zero coupon bond do not pay any coupon payment, so it sells on discount. The holder return is the difference between the price paid, which is less than the face value, and the bond face value. So how to calculate the price of a zero coupon bond? Now here is the formula to calculate the price of zero coupon bond, which is PB is the price of the bond, F is the face value, N is the number of compounding period, 1 plus I is the interest rate, M is the number of time interests are compounded, and N is the number of years, which also explains in here. Here PB is the price of a bond and the other definition has been included. So let's look to an example. Consider a zero coupon bond that has a face value of $5,000, semi-annual compounding, and 5 years to maturity. The current market interest rate is 5%. Calculate the price of a bond. As we know, the face value of the bond is $5,000, so we put 5,000 here. It has semi-annual compounding and 5 years to maturity. So semi-annual compounding, it means it compounds twice in a year. So 5 years multiplied 2 is 10. So the interest rate is 5%. So if we put all this information here, then we can calculate the price of a bond. Now this will be a task for you to calculate the price of the zero coupon bond. Now the next slide is about the bond price theorem. Bond theorems tells us about the relationship between bond prices and interest rate changes. There are 3 bond theorems that we need to know about. One is the bond prices and the yield. 2, bond prices volatility and maturity, and 3 is bond price volatility and the coupon rate. So let's look each of the theorems. The first theorem is bond prices and yield. This is the most straightforward theorem. As the market rate of interest declines, bond prices rise and vice versa. So if the interest rate in the market declines, the price of the bond will go up, and if the interest rate in the market goes up, at the same way, the price of the bond will go down. The main reason behind it, bond generally pays fixed interest rate. So if the market interest rate goes up, for the investor, they would like to change their investment attitude and they want to invest in other instruments that gives them a higher interest rate. So this is because the coupon rate on the bond is fixed. The only way to change a bond yield if the interest rate changes is to change its price. The second theorem is bond price volatility and maturity. Bond price volatility is the sensitivity of the bond prices to change in interest rates. Now please note that there is a relationship between bond price, volatility and maturity. The longer the term to maturity, the greater the price volatility. So on the other hand, we can say that the shorter the time to maturity, the smaller the price of the volatility. So how do we calculate the volatility? So let's look at the relationship between the price, maturity and market yield of the bond. So in the left side, we're showing the maturity in years, 1, 5, 10. So these are the number of years. Bond price at the 5% yield. So the bond price is the fixed $1,000. Here the price changes if the yield changes 6%. As we know, the bond price at 5% is $1,000. So if price changes to 6%. So if in the market price change, if in the market the yield changed to 6%, the bond price will decline. So it has dropped to $990.57. Loss from the increase in yield is $9.43. So 1000 minus 990.57 is 943, and the price volatility is negative 94%. The same way, if the price changes to 4%, so now the price, so if the market interest rate reduce. So now let's look what will happen to the bond price if the interest rate or the yield change to 4% or the yield decline. In that case, the bond price will be $109.62. Gain from the decreased yield would be $9.62. So how we can calculate, which is $100 minus 109.62, which is 9.62, and bond price volatility will be 96%. So the same way, if you look at year 10 or 10 years to maturity bond, the bond price at 5% yield is the same, $1,000. If price changes to 6%, bond price declined to $9.26, 926.40. Loss from increase in yield is $73.60, and the price volatility is negative 7.36. On the other hand, if price changes because of the yield change to 4%, will be $1,080.11. That will be the bond price. Gain from decreased in yield would be $81.11, which is the gain we can calculate from 1081.11 minus 1000, which is 81.11, and the price volatility will be positive 8.11%. So the next slide will look how we can calculate the bond price volatility. So this is a very simple formula. So in this formula we can look the bond price volatility, which is the percentage of changes in the bond price, which is equivalent to Pt minus Pt minus 1 divided by Pt minus 1 multiplied 100. In this formula, the Pt is the price of a bond at today's price, and the price of the bond of yesterday's price would be Pt minus 1 divided by price of the bond, which is yesterday's price, Pt minus 1 multiply 100. Let's look at to an example. Consider a bond selling at par with an 5% annual coupon. Suppose that the yield on the similar bond increased by 1 point bps to 6%. In terms of dollar, the price of the bond falls from $1,000 to $990.57, a decline of 9.43. Calculate the bond price volatility. So in this example, we know what is the price of the bond today, or the current price, which is 990.57. We know the price of the bond previously, or Pt minus 1 is 1000, and we also know that what is the coupon percent or the rate. So how we are going to calculate the volatility of the bond? What you need to do is simply just follow the formula and plug this information to the formula and calculate the bond price volatility. This is the task for you. The next theorem is bond price volatility and the coupon rate. This is the third theorem. It shows the relationship of the sensitivity of the bond prices to change in interest rate to the coupon rate. More specifically, the lower a bond coupon rate, the greater the sensitivity of a bond price to change in interest rate. This slide shows bond price volatility and the coupon rate, and in this chart is showing the coupon rate percentage, which is 0, 5 and 10. Bond price at the 5% yield is showing in here, and it's showing that the price changes if the yield changes 6% or the 4%, and how the bond price react. And this information is plotted to this chart. So just to quickly recap, that there are three bond price theorem. Number one is bond price volatility and the yield. Two is bond price volatility and the maturity. And number three theorem is bond price volatility and the coupon rate. Now in this slide is showing the formula of a fixed interest security, but if you look into the formula, it has one additional part, and the additional part is 1 plus interest rate power the k. Now if you look at to the previous formula for calculating the bond price, as you know that the bond price includes two things. One is the present value of the coupon stream, which is this part, and the second is the present value of the future value, which is the second part. However, the third part is to calculate when there is a time difference or the days difference. So let's look at to an example. Current AA corporate bond yield in the market at 8% per annum. An existing AA corporate bond with the face value of $1,000 paying 10% per annum half yearly coupons, maturing 31st December 2014. would be sold on Monday 20th of May 2009 at what price? So in this example, we can find that the face value of the bond is $100,000. The bond is paying 10% half yearly coupon payment, and the market yield is 8%. However, we do not know the maturity of the bond or the N of the bond. So we need to determine what is the N. If you look into this question, you can find that it is stating that the bond is maturing 31st of December 2014, would be sold on 20th of May 2009. Okay, so it's sold on 2009, but the maturing in 2014. So from 2009 till 2014, how many years are there? We need to first calculate. So if you take the full year 2009, 10, 11, 12, 13 and 14. So there are 6 years left. And the bond is paying half yearly coupon payment, so it is paying coupon payment twice in a year. So the N would be 12. So let's look at the next slide. So in this slide is showing that the N is 12. From where we get this 12? By calculating the number of years left. Okay, and we're calculating the price of the bond. If you look at the previous calculation, it is exactly the same. However, there is a bit difference. The difference is in this question saying that the bond would be sold in the market 20th of May 2009. As in this calculation, it is assuming that the bond sold between two coupon dates. So we need to calculate first how many days has been passed for that particular coupon period and the number of days in that particular coupon period. So let's look to the solution. So this is the solution. So from 1st of January till 20th of May, there are 140 days. From 1st of January till 30th of June, there are 181 days. Half yearly coupon payment. How you can calculate the 181 days? You can calculate the number of days in January, February, March, April, May and June. Add all those days number, you'll find 181. And from 1st of January to 20th of May is 140 days. How you're going to calculate? It is very simple. You add the number of days in January, February, March, April, and in the month of May you take on 20 days. So if you add all this, it's 140 days. So you already have the numbers for the price of the bond, and for the last part we just simply put 1 plus 0.04. 0.04 is the interest rate in the market or yield, power k. K is 140 divided by 181. So if you solve it, we find the price of the bond in the market will be 112,754.27. Hopefully you understand this calculation. Thank you very much for watching my video. If you like it, please do not forget to subscribe my YouTube channel. Thank you.